Welcome back to the quarterly call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. All right, we're diving into the Q1 2026 update today. And, for anyone watching the tech investment space, this quarter it felt like more than just strong numbers. It felt like an acceleration point.
Definitely. A real statement about where things are heading.
Exactly. So our mission here isn't just to recap the financials, impressive as they are. We really want to get under the hood and understand the sheer scale, the speed of the investments they're making, and crucially, what's driving this incredible growth, especially around AI.
Yeah, and when you dig into the Q1 results, the big takeaway is just how capital intensive this phase is. But the payoff is already starting to show. I mean, look at Microsoft Cloud revenue.
Right.
It crossed $49 billion. That's up 26% year over year. Just think about that number. $49 billion in cloud revenue.
Yeah.
It sets a massive baseline.
It really does. And maybe even more telling than the current revenue are the sort of forward-looking signals, like the commercial remaining performance obligation, the RPO.
Oh, absolutely. The RPO jump was huge.
That's the money they've booked but haven't recognized yet, right? It's just exploded, up over 50% year over year, hitting almost $400 billion.
Nearly $400 billion. I mean, a number like that, it tells you there's been a fundamental shift in enterprise confidence. These aren't small bets anymore.
It signals real commitment, long-term commitment.
Exactly. That RPO gives incredible visibility into future spending. It basically proves the demand for these new AI services is real, it's deep, and it's locked in for years. This isn't just experimentation. Companies are signing multi-year deals to transform how they operate using this stuff.
And I think, some might have worried that all this massive spending on infrastructure would hit profits in the short term.
That was the concern, yeah. But the scale they operate at seems to be absorbing it, and pretty efficiently, too.
Well, the numbers back that up. Operating income was up 24%.
Right. And earnings per share, EPS, came in at $4.13. That's up 23%. And remember, that EPS figure is after accounting for the significant investments in OpenAI.
So they're managing to pour billions into building this future while still delivering really strong, accelerating profits right now.
Precisely. It's a balancing act, but they seem to be nailing it.
So we've got the soaring demand, record bookings, profitable growth. It all seems to fall under what management is calling the AI mandate. It sounds like the demand for the AI platform for Copilots is basically forcing their hand.
It is. They have to commit huge resources, capital, talent, everything at a speed you rarely see. It feels almost like a wartime industrial effort, honestly.
Because they see this as a pivotal moment, a market they have to capture now.
I think so. It feels like a winner-take-most situation, and right now is defined by who can build the infrastructure fast enough. They simply cannot afford to let demand go unmet. That means a global transformation of their physical footprint.
And that infrastructure build-out, that's where the story gets really interesting, isn't it? The scale is just mind-boggling.
It really is. We have to look at the scale of this construction project.
Okay, let's unpack that. We hear the term AI factory thrown around a lot. What does it actually mean when they say they're building a planet-scale cloud and AI factory?
It's about industrializing the production of intelligence, but on a truly global level. It means a single focused effort to maximize efficiency. And they have a specific metric for it.
Right, the tokens per dollar per watt.
Exactly. It sounds technical, but it's crucial. They want to squeeze the absolute maximum number of tokens, the basic units of AI computation, out of every dollar they spend on hardware and every watt of energy they consume.
So maximizing the useful AI work done for the lowest cost in energy use.
Precisely. It's not some vague aspiration. It's a hard metric, driving decisions on everything from the chips they buy to how they write their software. If that number goes up, they get way more value from every single GPU, every data center, and that's how you justify the massive capital expenditure.
And the commitment to expanding capacity based on this, well, the numbers are just staggering. We're not talking small upgrades here.
Sure. No, this is industrial scale. They plan to boost their total AI capacity by over 80% this year. Just this year.
80%. Wow.
But then look at 2 years. Based on the demand they're seeing now, the plan is to roughly double their entire global data center footprint.
Double the whole thing in 2 years.
Yep. Think about the logistics of that. Doubling a planet-spanning network of buildings, power, cooling, fiber, the supply chain, the land acquisition, getting the power hooked up. It's an absolutely enormous undertaking.
And the individual sites must be getting bigger too, right? Like that Fairwater data center in Wisconsin they announced.
Fairwater is the perfect example of this new scale. It's set to come online next year, and eventually it'll scale up to 2 gigawatts of power capacity. 2 gigawatts.
Put that in context for us. How big is 2 gigawatts?
Okay, so a typical large nuclear power plant might generate around 1 gigawatt, and historically, a really big hyperscale data center, a massive one, might have been maybe 100 megawatts. Fairwater is planned to be 20 times that size eventually. It's approaching the power draw of a small city, all for AI and cloud.
It's hard to even picture that scale. And it's not just about pouring concrete. They're deploying the latest tech almost instantly.
That's key. They mentioned deploying the world's first large-scale cluster of NVIDIA's GB300s. That's the next-generation chip, the successor to the H100s everyone's been fighting over.
So being first with the GB300 signals what?
Two things. One, really deep engineering ties with suppliers like NVIDIA. And two, a willingness to move incredibly fast, take on operational risk to get that cutting-edge performance now. That speed is crucial for training the next monster models and for running real-time AI services.
Which brings us back to that idea of the fungible fleet. If they're putting in GB300s today, how do they make sure that investment isn't obsolete in, like, 2028?
That's the million-dollar question, or rather the multi-billion-dollar question. Fungibility is the answer. It means the infrastructure isn't rigid or siloed. It has to be flexible, adaptable.
So the same hardware can be used for different things.
Exactly. It needs to be continuously modernized and able to handle any part of the AI lifecycle, whether it's pre-training a massive new foundation model or running inference for 1 billion users on Copilot, or generating synthetic data, or even just running standard database workloads.
Yeah.
The system has to be able to shift that expensive capacity to wherever the highest value is instantly.
And that requires a lot of smart software on top of the hardware.
Absolutely. It's all about the software layers, the compilers, the schedulers, how the network is designed. That's where they're finding huge efficiency gains. Remember that example they gave about optimization?
The 30% throughput gain on GPT models? Yeah, that jumped out.
It's incredible, right? They increase the token throughput, basically how much work the models get done for GPT 4.1 and even the new GPT 5 by over 30% per GPU. And that wasn't by swapping hardware.
Just software tweaks.
Software and systems optimization, better code compilation, smarter network routing, faster data movement. Think about it. The GPUs they bought 6 months ago are suddenly 30% more productive. That gives them enormous confidence that their CapEx isn't going to waste because they can keep extracting more value from these short-lived assets.
Okay, so efficiency and scale handle the domestic side. But globally, things are getting complicated, which brings us to this digital sovereignty platform. That seems really important right now.
Hugely important and a real competitive edge. With all the geopolitical tensions and new regulations popping up, companies and governments are demanding control over where their data lives and how it's processed.
Data residency rules, basically.
Exactly. Azure now offers this comprehensive platform that lets customers in 33 countries build and run their cloud and AI stuff entirely within their own borders, meeting those strict local rules.
And we're seeing that play out in sensitive sectors, like government.
Yeah, the German public sector example is perfect. OpenAI and SAP are using Azure in Germany to build new AI solutions specifically for German government agencies. Those agencies have some of the toughest data sovereignty requirements anywhere. Being able to meet those needs locks in huge long-term contracts that others might struggle to win.
Okay, let's shift gears slightly to the other massive anchor this quarter, that definitive agreement with OpenAI. This partnership has always been important, but this agreement seems to really lock it in.
It's more than just locking it in. It feels like a statement of deep interdependence now.
Okay.
And first, you just have to acknowledge the financial return they've already seen.
Yeah.
They basically 10x their initial investment in OpenAI already.
10 times.
I
That's astronomical for a strategic investment in this time frame.
Almost unheard of. But the new agreement, that's what really drove that massive RPO number we talked about earlier.
Right, the nearly $400 billion. What was the specific commitment from OpenAI?
OpenAI committed to purchasing an incremental $250 billion worth of Azure services, $250 billion. That single commitment guarantees a massive amount of future consumption on Microsoft's AI factory. They are the ultimate anchor tenant.
And beyond the money, the terms of the partnership itself, the duration, that seems really significant for the long-term strategy.
It provides huge stability. The existing terms, the revenue sharing, the exclusive IP rights they get, the API exclusivity for Azure, all that continues until either AGI is achieved, whatever that means, or at least through 2030.
So guaranteed access for years.
Yes. And even beyond that, the rights to the actual model and product IP developed through the collaboration, those have been extended even further, out to 2032.
Wow, 2032. That anchors their AI strategy for almost the next decade.
It totally removes ambiguity. It solidifies the relationship, gives both sides the certainty they need for that long-term CapEx planning, and crucially, it ensures Microsoft's platform has primary access to the bleeding edge of foundation models for at least 8 more years. That access is probably their biggest competitive moat right now.
Okay, so we have the foundation, planet-scale infrastructure, efficiency, sovereignty, and the OpenAI partnership locked down. Now, let's talk about what people are actually building on top of all this, because capacity is great, but it's the applications that matter. The agentic revolution, as they call it.
Exactly. This is where the monetization happens. All that infrastructure is there to power the Azure AI Foundry. That's their main platform for developers and companies building AI solutions.
Foundry is the toolkit, basically. What kind of adoption are we seeing there?
It's widespread. They said 80,000 customers are using Foundry now, and that includes 80% of the Fortune 500. And a key part of its appeal is the sheer choice of models.
Right, they offer way more models than just OpenAI's.
Over 11,000 models now, more than anyone else. That includes GPT-5, of course, but also models from others, like xAI's Grok 4.
Why is having so many models important? Why not just stick with the best ones?
Because different tasks need different tools. You know, a giant model like GPT-5 might be great for writing a novel, but you might want a much smaller, faster, cheaper model for, say, summarizing customer service calls in real time or running on a phone.
Right, optimizing that tokens per dollar per watt for the specific job.
Exactly. Offering 11,000 models means customers aren't locked into one approach. They can pick the absolute best fit for their specific need and budget.
And Microsoft's own models, MAI and Phi, are part of that mix too.
They are, and performing well. The new MAI models for text, voice, and images launched strong, hitting near the top of leaderboards. But the really interesting story might be the Phi family, their small language models, or SLMs.
Smaller, more efficient models.
Exactly. Designed to be very capable but much less resource hungry. And the uptake on those has been phenomenal. Over 60 million downloads for the Phi models.
60 million, that's huge.
It's tripled year over year. This is important because these SLMs are becoming the workhorses for applications that need to run locally, on devices, or in situations where low latency is critical. They dramatically lower the cost of putting AI everywhere.
Can you give us some real-world examples of what companies are building with Foundry?
Sure. Take Ralph Lauren. They're using it to build a conversational shopping assistant right in their app. So you can just tell it, I need a blue dress, needs to be sustainable for a wedding this summer, instead of clicking filters. It gives you personalized results instantly.
That seems much more natural.
Totally. Or look at Open Evidence. They built an AI assistant for doctors. It uses AI to summarize patient histories, pull up relevant medical studies in seconds, basically saving doctors huge amounts of time on admin and research, which is critical in healthcare.
So Foundry helps other companies build, but the real driver of that immediate revenue growth, the ARPU uplift, seems to be their own first-party apps, the Copilots. How widespread is the usage there?
The scale is just enormous now. Across all their products, they're seeing 900 million monthly active users interacting with AI features. 900 million.
Wow.
And the dedicated Copilots themselves, M365 Copilot, GitHub Copilot, the security ones, they've crossed 150 million monthly active users combined. So AI isn't just a feature anymore. It's becoming a core part of the experience for hundreds of millions.
Let's zoom in on M365 Copilot. That's the one really boosting the Office suite revenue, right?
Absolutely.
Yeah.
Adoption is speeding up fast. They said usage intensity, how much people are actually using it,
Right.
jumped 50% just quarter over quarter. It's integrated everywhere, becoming this new conversational way to interact with Word, Excel, Teams, everything. Tens of millions are already using the chat function regularly just months after launch.
And it's evolving beyond just being a helpful assistant. This new agent mode sounds different.
It's a significant leap. Think about it. Copilot before was great for, say, summarizing a long email chain or drafting a quick reply. Agent mode takes it further. You give it a complex prompt like develop a marketing plan for this new product. And it doesn't just give you bullet points. It can generate a whole PowerPoint presentation or a detailed Excel model or a full report in Word.
Like a digital expert doing the work.
Kind of, yeah. And crucially, it can iterate. You give it feedback, it refines the output. It's moving from giving advice to actually executing complex tasks, much like coding agents do.
And they're making it collaborative, too, with Teams mode.
Which is essential for businesses, right? Work isn't usually done alone. Teams mode lets you bring colleagues into the Copilot conversation. You can work together with the AI to refine a document or brainstorm ideas.
And they mention specific collaborative agents.
Yeah, agents built right into Teams meetings. There's a facilitator agent that can help set agendas and summarize discussions as they happen. And a project manager agent that takes notes, tracks decisions, and even assigns follow-up tasks automatically. That could genuinely change how meetings work.
Beyond their own agents, it sounds like Copilot is becoming a platform for other agents too.
That's the strategy. The whole agent ecosystem is exploding. The number of users doubled quarter over quarter. Big software vendors like Adobe, SAP, ServiceNow, Workday, they're all building agents that plug into Copilot.
So M365 becomes the central hub.
Exactly. The operating system for all these different work agents. And companies are also using Copilot Studio to build their own custom agents for very specific internal processes.
And making it easier for non-programmers to build things.
Yeah, with the new App Builder agent, it's actually a Copilot agent that builds apps. It lets regular users create simple, task-specific applications in minutes using their company's M365 data securely. That could unlock a ton of internal innovation.
Okay, let's talk impact. These massive RPO numbers must be backed by serious enterprise adoption stories. How deep is M365 Copilot penetration in big companies?
It's deep and getting deeper. Over 90% of the Fortune 500 are using it now. And we're seeing huge deployments. This quarter alone, Accenture, EY Global, the UK's tax authority each bought over 15,000 seats. That's serious C-suite buy-in.
Are we seeing proof of actual productivity gains yet? Measurable ROI?
We are starting to. Lloyd's Banking Group deployed 30,000 seats. They did internal studies and found employees using Copilot are saving an average of 46 minutes per day.
46 minutes a day across 30,000 people.
You do the math. That's millions of hours saved annually. That time can be reinvested, or it translates directly to cost savings or increased capacity.
And the PwC story sounds like the ultimate example of this transformation.
It's really dramatic.
Yeah.
PwC added another 155,000 seats this quarter. They now have over 200,000 deployed globally. Their people have interacted with M365 Copilot over 30 million times in just 6 months.
30 million interactions.
Yeah. And PwC is explicitly saying this is saving them millions of hours of employee time. It's changing how their consultants do research, analyze client data, prepare proposals. It's becoming fundamental to their business model.
Shifting from general office work to coding GitHub Copilot seems unstoppable there.
It really dominates. Over 26 million developers are using it now, making it easily the most popular AI pair programmer.
Yeah.
And GitHub itself is growing faster than ever. They said they're adding a new developer to the platform every single second.
Wow. And those developers are actually using Copilot heavily.
Seems like it. Over 500 million pull requests were merged on GitHub in the past year, many presumably touched by Copilot. And they noted 80% of new developers start using Copilot in their first week. It's becoming table stakes for coding.
Are big companies deploying it widely too?
Yes, like AMD deployed it to tens of thousands of their engineers. They reported those engineers are accepting hundreds of thousands of lines of code suggestions every month, saving huge amounts of development time.
And just like M365, GitHub is creating an organizing layer for agents with Agent HQ.
Exactly the same pattern. Agent HQ acts as the central control panel for all coding agents, not just GitHub's own. It integrates with agents from OpenAI, Anthropic, Google, xAI, whoever.
Why is that central control important?
Because it extends familiar GitHub tools like pull requests and issue tracking to manage these agents. It provides governance, makes it easy to see what the agents are doing, ensures human review happens when needed. It brings order to what could otherwise be a chaotic mix of different AI tools.
That idea of an organizing layer feels even more critical in security.
Absolutely. Security is all about speed, volume, and coordination. They now have over 36 AI agents woven into their security products. Entra for identity, Defender for endpoints, Purview for compliance, Intune for device management.
Using AI to fight AI-powered threats.
Pretty much. And the efficiency gains can be huge. Look at the phishing triage agent in Defender. They found it makes security analysts up to 6.5 times more efficient at sorting through suspicious emails.
6.5 times faster in a world drowning in security alerts.
That's massive. It means the human experts can ignore the noise and focus their time on the genuinely complex, dangerous threats, while the AI handles the initial high-volume filtering. It's a game changer for security operations centers.
And beyond the big enterprise areas, we're seeing impact in specialized fields like healthcare.
Yeah, healthcare is a key focus, especially for tackling clinician burnout. Dragon Copilot is all about automating medical documentation, which is a huge time sink for doctors.
How much documentation?
This quarter alone, it documented over 17 million patient visits. That's almost 5 times higher than last year. And over 650 healthcare organizations have bought the ambient listening tech and the part that listens to doctor-patient conversations and writes the notes automatically. Big names like University of Michigan Health are rolling it out to thousands of physicians.
Okay, finally, let's touch on the consumer side. How is AI showing up for regular users?
The big picture is that every Windows 11 PC is now being positioned as an AI PC. They keep adding features to embed Copilot deeper into the operating system itself.
Like what kind of features?
Things like a dedicated Copilot wake word, so you can just talk to it. Vision capabilities, letting Copilot actually see what's on your screen and talk about it. And action capabilities, allowing it to interact with apps for you. The goal is to make the PC feel like a conversational agent.
Are consumers actually using the standalone Copilot app?
Usage is growing fast. Daily users of the consumer app jumped nearly 50% quarter over quarter. And the Edge browser keeps benefiting from AI features, gaining market share for 18 straight quarters now. They also launched Microsoft 365 Premium for consumers, bundling Office apps with more advanced Copilot features for power users.
Okay, so we've painted a picture of massive demand, rapid deployment across all segments. Let's circle back to the financials and the tough questions analysts are asking. All those huge bookings raise concerns about capacity, the sheer level of spending, and potential risks.
Yeah, this is where we get into the trade-offs and the management strategy behind the numbers. The commercial bookings growth 112% or 111% in constant currency. They explicitly said it was significantly ahead of expectations.
And driven by those huge deals.
Exactly. The OpenAI commitment was a big part, but also just a surge in contracts worth over $100 million. It's undeniable proof of accelerated enterprise adoption at scale.
And that feeds directly into the $392 billion RPO number. But with contracts that big, is there a risk customers are signing super long deals based on today's tech, which might change?
That's a really important nuance, and the data actually points the other way. Even though the RPO balance has almost doubled in 2 years, the weighted average duration of those contracts has stayed pretty stable at only around 2 years.
Only 2 years. What does that tell us?
It tells us customers expect to consume these services fast. They're signing up for huge amounts, but they plan to use it quickly because they're seeing immediate value. It's not about locking in for a decade. It's about enabling rapid transformation now.
Okay, let's break down the CapEx. $34.9 billion this quarter. That's a staggering amount of investment. What's the thinking behind spending at that level?
It's directly tied to that cloud and AI demand, but they manage it strategically in 2 main categories. About half the spending went on what they call short-lived assets.
GPUs and CPUs, mostly.
Primarily, yeah. The high-end chips. These have a shorter useful life, maybe 3-5 years, and the investment here is designed to match specific contract durations or near-term demand forecasts. They need these for Azure growth, for running M365 Copilot, for their own R&D, and replacing older servers.
And the other half of the spending.
That goes towards long-lived assets. This includes $11.1 billion in finance leases this quarter. We're talking about the data centers themselves, the land, the buildings, the power infrastructure, the fiber optic connections. These are assets expected to generate revenue for 15 years or more.
So they feel confident the physical sites will remain valuable long-term, even if the chips inside change.
That's the bet. The fungibility of the sites themselves justifies that massive upfront cost.
But here's the kicker. Even spending $34.9 billion, they're still capacity constrained. Demand is just outstripping their ability to build.
That's the core tension right now. Management was very upfront about it. Demand is significantly ahead of supply, and they expect this capacity constraint to last through at least the end of fiscal 2026.
So for the next year and a half, minimum.
Yeah, this isn't just a temporary blip. It's an ongoing reality driven by absolutely explosive AI demand.
So if you have a limited resource compute capacity, how do you decide who gets it? What's the prioritization?
It's a calculated strategy aimed at maximizing long-term value and profit. The priority order seems to be, first, core Azure customer commitments. Second, their own highest margin first-party apps, especially M365 Copilot. Third, their internal product R&D. And fourth, replacing old servers.
So Azure growth is actually being held back deliberately to feed Copilot and R&D.
They basically admitted that. They said Azure revenue growth is the most impacted by this prioritization, which means the official Azure growth numbers, as strong as they are, actually understate the true underlying demand because they're actively choosing to allocate scarce resources elsewhere.
Which brings us right to the bubble question. Analysts keep asking, are they building too much, too fast? Is this sustainable, or are we inflating an AI infrastructure bubble?
Management pushed back hard on that, pointing to a couple of key things. First, that enormous RPO, nearly $400 billion in contracted future revenue. That's not speculation, it's booked business, giving them high confidence in future usage.
Okay, so the demand side looks solid. What about the supply side risk? Investing billions in assets that might become obsolete.
That's where the accounting and operational strategy comes in. Financially, the depreciation schedule for those short-lived assets, the GPUs, is explicitly matched to the duration of the contracts they support. They aren't buying billions in chips without a clear, contracted revenue stream tied directly to them. It's a financial hedge.
And operationally, it goes back to efficiency.
Exactly. That token factory efficiency we talked about. Their ability to get 30% more performance out of existing GPUs through software updates means their hardware investments are more durable. They can stretch the life and capacity of what they have, making them less vulnerable to rapid obsolescence than someone with more rigid infrastructure.
Let's tackle the really big uncertainty, AGI, artificial general intelligence. If or when that arrives, could it just completely reset the competitive landscape and undermine their current advantage? How did they address that?
Their response was interesting. It focused less on the ultimate capability of AGI and more on the practicalities of using powerful AI today and in the near future. The CEO stressed that even as models get smarter, their intelligence will likely remain jagged or spiky for a while.
Meaning good at some things, terrible at others, unreliable.
Kind of, yeah. A model might be superhuman at writing code but hallucinate basic facts or lack common sense or fail to follow safety protocols. It might be powerful, but not trustworthy or consistent enough for critical business use on its own.
So the raw intelligence isn't enough.
Right. Their argument is that the real defensible value lies in building the systems around the models. The organizing layers like M365 Copilot or GitHub Agent HQ. These systems are designed to smooth out those jagged edges. They provide the iteration loops, the compliance checks, the data grounding, the security, the integration, all the enterprise-grade stuff that businesses actually need and pay for.
The model is just one component, the system is the product.
That's the idea. That system becomes the moat, ensuring reliable, safe, compliant delivery of AI, regardless of exactly how smart the underlying model gets on any given day.
And this system approach actually expands the market.
That's the key financial point. AI isn't just replacing old software, it's creating entirely new high-value capabilities you can sell on top. They compared the potential Copilot ARPU, average revenue per user, to the base M365 ARPU. Just like cloud created a much bigger market than physical servers ever were, AI is expanding the total addressable market for productivity, coding, security, etc.
Okay, one more tough financial question. Concentration risk. With deals like the massive OpenAI commitment, how do they balance supporting these huge digital native customers against their core enterprise business, especially when capacity is tight?
Strategic choices are key here. And again, it comes back to fleet fungibility. Because they've built their core infrastructure to be flexible and adaptable across all customer types, big tech, enterprise, their own products, they aren't locked into building highly specialized infrastructure for just one massive client.
That flexibility gives them leverage.
Yes, and they confirm they are actively making choices. They're willing to say no to certain types of demand, even if it's huge volume.
Saying no to potential revenue when?
When the demand is too concentrated, not just concentrated on one customer, but concentrated on one type of resource. For example, if a potential client wants massive amounts of just raw GPU power, the AI accelerators, but doesn't need a corresponding amount of general compute, storage, or networking, that contract might not fit the strategic goal.
Why not?
Because their goal is to build a balanced, fungible fleet that optimally supports their highest margin services, like Copilot, which use a mix of resources. Taking on too much highly skewed demand could compromise their ability to serve their most profitable products. So they're prioritizing long-term architectural balance and margin profile over just grabbing every possible revenue dollar right now.
That's a significant strategic choice. Okay, before we hit the segment breakdown, one accounting clarification. There was a big number in other income expense, a loss of $4.1 billion. What was that?
Yeah, that caught some attention. Management clarified that number was entirely due to Microsoft's share of OpenAI's operating losses, based on the equity method of accounting. It reflects the huge R&D and operational costs happening inside OpenAI as they race towards AGI.
So it wasn't related to the new $250 billion Azure deal?
No, completely separate. It's basically an accounting reflection of their ownership stake in a company that is investing incredibly heavily, largely a non-cash item from Microsoft's perspective.
Got it.
Okay, let's quickly run through the performance of the main business segments, starting with productivity and business processes, PVP, the Office, Dynamics, LinkedIn segment.
PDP had a really solid quarter. $33 billion in revenue, up 17%. And the key driver was ARPU growth in the M365 commercial cloud.
More revenue per user. How?
Two things mainly. Customers upgrading to the higher tier E5 licenses,
Which include the advanced security and compliance tools.
right? And significantly, the adoption of Copilot. It seems Copilot is actually pulling customers up into those more expensive E5 bundles, which is exactly what they want to see. And on the consumer side, M365 subscriptions topped 90 million.
How did LinkedIn do within PvP? There were some concerns about the hiring market.
LinkedIn revenue was up 10%, mostly from marketing solutions ad spending held up, but the talent solutions part, the recruitment side, definitely felt the impact of the weaker global hiring market. So a bit of a mixed picture there, reflecting broader economic caution.
And Dynamics 365, their business application suite. Dynamics 365 grew a strong 18%, and they said it gained share across the board. ERP, CRM, all of it. Looking ahead for PvP in Q2, they're guiding for 13% to 14% growth, again led by that M365 commercial ARPU lift from E5 and Copilot.
Okay, next segment, intelligent cloud. I see. This is Azure, server products, the core infrastructure story.
IC hit $30.9 billion, up 28%. The number everyone watches is Azure and other cloud services growth that came in at 40%.
40% growth for Azure, still massive.
Massive, but remember that was capacity constrained. They said demand exceeded supply this quarter. So that 40% reflects how much they could deliver, not necessarily the full demand picture. If you had had more capacity, it likely would have been higher.
And within Azure, the data and analytics pieces are critical for AI readiness. How did they perform?
Phenomenally well. Fabric, their unified data platform, saw revenue grow 60%. They called it the fastest growing data platform in the industry. It now has 28,000 paying customers. People are clearly prepping their data for AI.
Other database services strong too. Yeah, SQL DB Hyperscale was up almost 75%. Cosmos DB up 50%. Huge growth across the board as companies modernize their data infrastructure.
So what's the Q2 outlook for Intelligent Cloud, given the ongoing capacity constraints?
They're forecasting Azure growth around 37% in constant currency for Q2. Again, that number is fundamentally shaped by the capacity limits and the prioritization strategy we discussed. They also expect the traditional on-premises server business to decline slightly as customers continue moving to the cloud.
All right, last segment. More personal computing, MPC. This is Windows, Surface, Search, Gaming, often more cyclical.
MPC revenue was $13.8 billion, up 4%. Windows OEM revenue was actually stronger than expected, up 6%.
Why the strength in Windows PC sales?
Partly demand ahead of the Windows 10 end-of-support deadline coming up, pushing some upgrades. And also, it seems PC makers drew down some excess inventory they were holding.
What about search and advertising?
Continued strong growth there. Search and news advertising revenue was up 16%, excluding traffic acquisition costs. And the Edge browser gained share again for the 18th quarter in a row, largely thanks to those integrated AI features.
And gaming. How did Xbox do?
Gaming revenue was actually down 2% overall, but that was against a really tough comparison from last year when they had some major releases. Xbox content and services revenue eked out a 1% gain, helped by third-party game sales. And Minecraft hit a new record, 155 million monthly active users. Still a juggernaut.
What does the Q2 guidance look like for MPC?
They expect Windows OEM revenue to decline in the mid-single digits as that inventory situation normalizes after the Q1 strength. Device revenue likely down too. And gaming revenue is also expected to decline low to mid-single digits, again because of that tough prior year comparison, even though subscription growth should continue.
Okay, let's try to pull this all together. The big picture for Q1 2026 seems incredibly clear. You have this massive acceleration in demand, proven by the RPO and bookings,
Driven by the diffusion of AI into everything.
which is translating into real large-scale deployments right now. And that forces their hand on making these huge, strategically managed capital investments.
Which in turn leads directly to these temporary but clearly anticipated capacity limitations. Every decision prioritizing Copilot, focusing on fungibility, being selective about contracts, it all points to managing through this constraint to maximize long-term value.
So the key takeaway, the knowledge nugget for listeners, it feels like the company's long-term financial health hinges on two connected ideas. First, making that incredibly expensive infrastructure fleet fungible, so the billions spent on data centers stay valuable for decades, even as the chips inside evolve.
Right, protecting the long-lived asset investment.
And second, successfully building and scaling these high-value agent systems, the Copilots, the agent HQs, because those are what generate the massive new revenue streams from productivity, coding, security, the streams that ultimately have to justify pouring all this capital into the AI factory in the first place.
Exactly. It comes back to the system, not just the raw model, delivering the repeatable enterprise-grade value. That value is measured in those millions of hours PwC is saving, enabled by that constantly optimized, fungible, planet-scale infrastructure. It connects the investment directly to the payoff.
Which leaves us with a final provocative thought. Building on this idea of capacity constraints and strategic choices, if Microsoft keeps choosing to decline certain high-volume, potentially lower-margin contracts, especially those that only want one type of resource, like raw GPU power, in order to save their limited capacity for their own high-margin apps like Copilot and for R&D, what's the long-term ripple effect?
Well, it could force competitors into taking on those less balanced, potentially less profitable workloads, right? If the leader is cherry-picking the most valuable integrated workloads, it might skew the economics for everyone else trying to compete in the AI cloud space.
It potentially shapes the entire ecosystem structure, allowing them to funnel their prime capacity into widening their lead in the most lucrative parts of the market, the agent systems themselves.
It's a strategic gamble, but one based on maximizing the value of every constrained resource they have. The consequences could be quite significant down the line.
Something to definitely keep an eye on. Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.